Hi, my name's Gary Booysen. I'm from Vunani Private Clients, and I'm going to take you through a little bit of what our market's doing at the moment and some of our favorite shares. Bear in mind that the share price information is quite time sensitive, so we're filming this on the 26th of June 2014. And I think you'll probably be able to check on how the picks are doing. But let's first look at overall market performance for the year so far. So what I've put up for you here is just how our market is doing, as well as the different sectors, as well as some of the more popular international indices. As you can see, the year-to-date return on the top 40 is sitting at about 9.4%, which is fairly decent when you consider what interest that you're getting in the bank. Traditionally, our top 40 will do probably between 13 and 18% per year for you. Over the long run, if you sort of compound it. But 9.4%, you're pretty much on track for about an 18% year. That barring any proper corrections in the market, which has run fairly hard over the last 5 years since the 2008 correction. As you can see, the mid caps sort of trailing with about 5.51%, and the small caps coming in second with 7.70%. If you look at the overseas markets, you can see that as an emerging market, we definitely still flavor of the month. And you can see the S&P coming in, which is the US market, the top 500 largest companies in the US, coming in at 6%, with the Dow, which is the Dow 30, which is a price-weighted index, only doing about 1.75%. So definitely emerging markets looking good at the moment. If we move on, if we look at what shares have performed the best this year so far, this is actually a one-year rolling figures. But you can see Sibanye Gold, almost 300% profit in Sibanye Gold so far. Obviously, Sibanye is the spin-off from Goldfields. So we don't have a lot of price history on Sibanye, and it has been a very volatile stock. It listed at somewhere around 16 Rand and almost lost half its value, but is back up. But whenever you're looking at the gold miners in a South African context, which Sibanye definitely is, you're going to be a slave to what the dollar gold price does, what the currency does, and of course our electricity tariffs and our labor situation at the moment. So nice to see a recovery there. It is a smaller cap gold miner, so you are likely to see volatility. I have filtered this by the all share index, so you are going to get some of the smaller cap companies in there where they generally do have larger price movements, especially if the share price is lower. But coming in second place, we're looking at Telkom, which has also been a fantastic turnaround story. Long been the dog of the JSE and turned at around 11 Rand, and has since actually become the second best performing share in our markets. And I mean, obviously, a lot of guys looking at it and saying, the management perhaps hasn't been up to scratch, but over the last year or so, it looks like our local fixed line operator is making some strides after unbundling Vodacom. So nice to see that up there. Third place Steinhoff, also 138%. Very respectable performance. After trading at sort of 26 a share, we would run these sorts of things when we're selecting stocks through what's called a quant model or quantitative model, which would screen out things like, has it been growing, return on equity for 5 years? Is its PE, its price earnings ratio in the correct band for us to be looking at attractive? And say we'll apply 15 or 16 criteria. Our house model at the moment actually has Steinhoff at number 1, and it has been for a while. So I mean, a fantastically run business, and it looks like the performance is definitely there. But if we had to pick 3 shares, and now this obviously I'm putting my neck on the line for you guys, because you'll be able to check me for the next while on how these companies are doing. If I had to buy 3 companies for the next 3 years, I mean at least next 10 years, what would they be? The companies that I've selected, I'll go through them one. The first one is Sasol. Obviously, our market, like you can see, our market is fairly extended at the moment. So, it is difficult to sort of find value in some of these counters. I think we're trading on an average price earnings multiple of, it's around 20 at the moment. So if you look at Sasol, I've put up some of the basic metrics that we're looking at the moment. It's a PE of 10. Obviously, an integrated oil and gas company with substantial chemical interests and production facilities in South Africa, Europe, North America, and Asia. The company also operates commercial scale facilities and produces fuels and chemicals from coal in South Africa, and is also developing ventures internationally, especially in natural gas, which I think is probably one of the biggest kickers for this company. They've obviously got the Louisiana project coming up, which is a massive ethylene cracker that they're building to take advantage of very low natural gas prices in the US. Could be a huge profit spinner for the company. I mean, I've given you the geometric, at least geographic segmentation for the company. So you can see these are slightly older revenue numbers, but you can see the growth in revenue that most sell-side analysts are looking at. It's between sort of 5 and 8%. So nothing spectacular, but stable. So it's definitely one of the blue chip companies in South Africa. If we look at some of the reasons that you might want to consider owning Sasol, it is a rand hedge stock. What we've calculated is for every 10-cent movement in the rand dollar, you get about almost R1 billion in EBIT, which is earnings before interest and tax. So obviously, as the South African currency weakens, you get huge sort of profit advantages through Sasol. So if you do have a lot of your money locally, if you own local property, if you own sort of very local assets, something like Sasol will add a rand hedge to your portfolio. We've already discussed the Louisiana project. Something else that is definitely streamlining Sasol as a company is their new Project Phoenix, which is a whole restructuring. I mean, they're going to try and really cut out, at the moment, it's about 3 billion rands worth of cost out of the company. Obviously, to cut their costs and maintain their revenue line, you're looking at increased margins, which is always going to be good for the company. Another last thing, reason that Sasol really is probably ahead of your more international plays like I'd say BP or Shell, I think it is their coal to liquids technology, which I think is fantastic. I mean, and it's not so much that they're just an oil and energy company. Very much they're a technology provider as well, and that's exactly why they're going to the US to use that sort of gas to liquids formula that they've developed in South Africa as part of their GTL, at least their CTL, their coal to liquids project, and hopefully they're going to take advantage of that. So looking at it, definitely one that I would own. If you look at the share price over the last 10 years, you can see a massive appreciation in Sasol. It is one of the very blue chip companies. I mean, you can see it really has moved up quite strongly. Now that price, to me, if you were a technical trader, you would say, but that looks like it's gotten a little bit overbought and you should be looking for a pullback here. Perhaps you can wait for a pullback, but again, remember this share's trading on a price earnings multiple of only 10. So really, if you're buying this, your earnings are going to pay off your investment in 10 years anyway. And definitely, that looks like an attractive counter for me. The second share that I like, one of my all-time favorites on the market at the moment, is Aspen. Aspen is a global supplier of branded and generic pharmaceuticals and of consumer and nutritional products in selected territories. Again, this one you can see slightly more expensive than Sasol. I mean, here you're looking at the other end of the spectrum, the PE sitting on about 36. You can see the forward PE, which is taking into account where they estimate the earnings to come from, at about 27. So it is a little bit lower. I mean, it does trade at a premium because it is a very, very good business. You can see your 12-month return on Aspen so far has been about 55%. So well outstripping definitely probably what the market has been doing. Also a small dividend yield as well, but it does have an increasing dividend policy run by Stephen Sard, who is really visionary in the generics business. If you look at Aspen, why you'd want to have it, they've got a deal with GlaxoSmithKline at the moment. So remember, they sell generic drugs. Glaxo, they actually, when drugs come off patent at Glaxo, they actually get given to Aspen almost a year ahead of what what other generic manufacturers will get the drugs. So they have time to ramp up their facilities, their manufacturing facilities, far quicker than what the competitors have, and that's given Aspen a huge advantage in the market. Through recent deals, I mean, they've increased sales forces in Russia and Australia. I think if you look at it, I stand to be corrected on this, but at the moment they sell, I think it's 1 out of 5 prescriptions written in Australia is for Aspen Pharma drugs. And that really their positioning in Australia and their positioning in South Africa really gives them access into the emerging markets. So through Australia, they can now they've already said that this is the springboard that they're going to launch into Asia. So you can already see their targets in China quite aggressively, and they want to grow in China. Obviously, in South Africa as well, they're looking at moving up into Africa quite aggressively, which is, I think, important because especially for a company that provides generic drugs, that's definitely where the opportunities are. Like I said, big is beautiful. Well, I've chosen you three very blue chip stocks today, something that you can start a portfolio with. Even when markets are high, it's always good to buy these companies. Big is beautiful. Aspen, you've got huge geographic diversification. So you've got them sitting in about 100 countries with about 60% of revenue coming from outside their borders, which again adds almost a rand hedge component to Aspen. If we look at the share price chart, you can see also an amazing success story and one that, I remember arguing with a client of whether we should buy it at 79 Rand or 81 Rand. And eventually I convinced him we must just buy this at 81 Rand. And I'm glad we did, because now trading at 307, that 2 Rand becomes almost irrelevant. I mean, it's been a fantastic success story, and I think the chart really speaks for itself. The final company that we're going to look at is SAB Miller. It's an international beer company. Most of us will know it. The company bottles and distributes beer through breweries worldwide. SAB also bottles and distributes a number of soft drinks. Again, it's a slightly more expensive stock, but on our market, guys do pay a slight premium for the rand hedge qualities, trading on a PE of about 26. A dividend yield of about 2.02% at the moment. This is almost a trillion rand company. It's the second biggest brewer in the world. You can see where its growth is going to come from. So obviously South Africa and Europe, the more developed economies, there has been a little, their volume sales, it is difficult to grow volumes because they are so large. This isn't a small cap that's going to double and triple overnight, but it's somewhere that you can put money safely for the long term. Looking at Europe, you're looking at revenue coming down slightly, but you can see where the real kicker is. Again, it's coming from Asia. You've got, the forecast 3-year growth in Asia is around 79%. At 3.3 billion, you're going to see that line grow fairly dramatically. If you look at the other reasons you'd probably want to buy it, other than the global diversification and the entry into Asia, remember it's got very high barriers to entry in most of its markets. SAB, throughout Africa, it's either number 1 or number 2 in that market. And once you have the brewery set up, it's very difficult for competitors to come in and compete with you because you have the economy of scale that you can produce beer. They won't be able to get to into the same league as you when it comes to cost. The reason that it perhaps is trading at premium at the moment is there's been a lot of rumors in the market that Anheuser InBev could potentially buy out SAB. If you look at the geographic overlap of the two companies, Anheuser obviously the number 1 largest brewer in the world. If you look at their geographic territories, it almost fits like a puzzle. So you've got SAB really taking over the emerging markets, with Anheuser very developed in the very prevalent in the developed markets. So it looks like it is a possible deal. It will be a mega merger of massive scale. There has been some talk about it recently with guys saying that if Anheuser does make an offer, it could potentially be at a 40% premium, which has obviously put a lot of little fire under SAB. So you've seen a fairly quick run up in the share price. Obviously, they are growing premium brands as well, which is their high margin business. Generally, it is a large company. It's an industry that is fairly defensive. Doesn't matter if the world slips into recession. SAB people will drink beer no matter what. So we'll definitely want to look at. Again, if you look at the share price chart, looking very similar to the other ones, and part of that is the currency hedge component, but also because fantastic business, all the way up to looks like 603 at the moment. Okay, so how have these companies performed over the last 10 years? So if we look at them, all of them, at the bottom line there, I've put the top 40, which is most fund managers. If you're investing in stocks, you probably want to use some, especially sort of the blue chip larger stocks. You probably want to use something like the top 40 as your benchmark. So if you pick a stock, it should do better than the overall market. That's what your goal should be. You can see over 10 years, the total growth in our market has been 385%. So that's almost 4 times your money, which is not too bad. If you had just bought something like the Satrix 40, you bought a passive index tracker. Obviously, you do get dividends on stocks as also your total return, including dividends. You're looking at about 543% growth over 10 years in our market. You can see all of these stocks, outperforming our market substantially. Obviously, with the real winner being Aspen outperforming massively. I mean, you're talking literally, if you'd bought Aspen at 12 Rand 50 10 years ago, you'd be looking at almost 20 times your money. So absolutely fantastic growth from really quality businesses, not small cap penny stock type companies. So if you had invested 300,000 Rand, if you had invested 100,000 Rand into each of these companies 10 years ago, not 300,000 Rand, 300,000 Rand in total, you would have 3.5 million Rand today in 10 years. So massive growth in wealth. That's without dividends. Obviously, if you include the dividends in that, your 300,000 Rand investment into 3 stocks, 100,000 per counter, you would result in literally having 4.62 million Rand in your bag, or at least in your trading portfolio. So well outstripping inflation and definitely growing your wealth well ahead of just about any other asset class. That's me.